Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Thank you for joining us for Money on Tap. Today, we wanted to do a playback on what you, our radio and podcast listeners, have been queuing up this year and bring it back one more time for 2023.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Crossman, joined here with Ben Brayshaw and Dan Mickelin. We're talking about the time is now. And what time is that? Right now might be the time for you to go and check us out on a podcast. You can go to iTunes or iHeartRadio, wherever you get your podcast. What are we talking about? The time is now for you to ask yourself the question, is it time for me to have an advisor? Or do I have the right advisor? We're going to give you the playbook, folks, and this is coming straight from three professionals, financial planners, fiduciaries in this industry. This is what we do with most of our week, at least. A lot of what we talk about are questions from you. You know, we sit down with our clients and what's important, because you're the most important person in the room, right? And we want to make sure that we're clear. We give you a playbook so that at the end of this time today with us, you know what you can go forth into the world of investment advisors prepared to either find the right advisor or maybe take a look at a new relationship, because maybe that relationship that you're in right now, maybe you've just outgrown it, kind of like a pair of shoes. It happens. You know, people level up their investing, and some advisors really work in one capacity well. They did great there, but maybe it's time to open it up and see what else there is. So with that, when is the first thing, point number one, we want to make today. And right now is a great example of when, because market conditions, what's going on with you today or what's going on in the world, in the market today, has got your head spinning. What do I do? Banks are collapsing, or maybe they are or not. I don't know. And rates are going through the roof, or maybe they're not. That's the market, folks. And if you do not stay in touch, it's easy to get left behind.
These are the litmus tests. These like this banking crisis. This is the litmus test of when, you know, you're over your head. That's the first thing. It's also a litmus test if your advisor's over your head. Like, you know, if you're experiencing, you know, these dramatic downturns in the banking world, like, you've got to have a conversation about that. We got out of banking, I don't know, 6-8 months ago. I can't remember when it was. We were completely out of the financial industry directly, like literally the ETF financial sector.
In our portfolios.
Yeah. And I'm just, you know, like, I mean, not that we had some sort of foreshadowing on this, because I don't want to think that like we had some crystal ball or what's going on. But I think of the economist, Mohammed El-Erian, he's from Allianz, and he talks about stuff all the time. But one of the conversations he's had is about Lehman Brothers, you know, and the idea that, you know, they didn't know what was going to happen with Lehman Brothers, but they have conversations about certain things so that when crises occur, that they're prepared to know why they own everything and why they need to get out of everything. And they sold Lehman Brothers long before most of the, you know, competitor investors in the marketplace did, because they already had a decision of what they would do in any event. And he said, we never foreshadowed that was going to be the case. You know, we really try to make that kind of statement, but the reason we talk about market conditions and this banking crisis specifically is that if you have a massive drop in your portfolio, totally unexpected, you got to have a conversation of, are you in the right portfolio? Did you own more risk than you should have had? You know, were you overexposed to one sector? You know, these are where market conditions really create that concern. And I think a lot of people have realized one of two things. Either I own something I shouldn't have owned, I've experienced something I shouldn't have experienced, or experienced something I can't afford to experience, and I'm either investing this and managing this myself, or somebody's doing this for me and it's not working.
Yeah, I think there's two things that come to people's minds, and this is on the conversations we've been having, because we're getting, you know, more and more calls from people who are seeking advice. It's, you know, first people, you know, that have an investment portfolio, they experience the loss. The first question is, well, why did I have that? You know, and they're upset about it for a moment. But then the second question is why didn't the person I'm paying for advice call me about this?
Yeah.
And why do they allow me to still be in this? and then that's when the phone rings, right? Then that's when they pick up and seek advice from a different source. And again, it's not that we have a crystal ball, but it is that, one of the things that we aim to do is have ongoing conversations with people, and we discuss our philosophy and what's included in our portfolios and why it's there. And we'll take that conversation as deep as people want to get, and that varies quite a bit. But this, proactive approach and, ongoing active management are the things that we offer here that, quite honestly separate us in times like this when conditions dictate that you can't just buy and hold and sit on it forever. That's not the time we're in right now.
Yeah, and I think there's a whole other aspect to this too, that kind of owning the generic banking world and all of those pieces to it. It just points to it, and it's not about banking. It's not about having owned banking. It's technology stocks and so forth. And we've started deleveraging out of technology stocks. We actually made some intentional sells there. That doesn't mean that that's where we think the entire market's going. We think we've made decent returns there, and we're happy to take some profits, and we're looking for other opportunities. And this is all part of the management. But I think, Dan, about the number of times we've sat down with people and asked, just curious, like, how did you end up owning this investment? And the blank stares we get, I mean, it's not like, I don't know, sometimes the blank stare, and most of the time it's like, well, I don't know, like the guy that I was working with bought it, or someone told me about it or whatever. They don't have like I was looking at the PE and, the RSI, and I was I felt like the standard deviation of this stock was really appropriate for me. Like no one gives you those responses. I've never had one person sit in my office. So if somebody wants to challenge me, bring it in, come in and have those conversations. That's fine with me. Usually people are like, well, I heard about this, or it seemed like a good company, or my dad used to work there, or it's a company I worked for many years ago. There's usually an emotional, historic connection, but it's not direct research. It's usually just a guesswork.
There's a lot of what I'm hearing is the relationship piece here, and having that connection, having that relationship. And I'm immediately thinking of how many people I've talked to over the last several months that their relationship has been with a robo-advisor, which, if you're not familiar with robo-advisors, it's not a term that we necessarily talk about as much as we used to, because it was a thing. It was a hot topic for a while, and everybody was going into these not everybody, but people were sending their money into these robo-advisors because they're using an algorithm that puts them in the right mix of ETFs and investments for their risk profile. And, and it's super low cost, and it's easier to, or whatever, that, there's a sell around this. People buy in, right, to the idea. And that worked maybe for a period of time, but now those robo-advisors are having a very similar conversation to what we're having. Like, oh, well, now is not the time necessarily to be the passive investor or 100% passive in the market. And they're starting to unwind some of the script of what they were selling 5 years ago as the greatest thing since sliced cheese. And guess what? They're also not necessarily, or they're kind of trying to offer this relationship, but it's at a cost, right? You want to have a relationship now, and it's not just, throw the numbers in the bucket. It's going to have a cost to it. And it's just interesting to hear these people coming through these paths and these learning experiences. We all have them. And in hindsight, thinking, well, what did I learn from this, and where am I at now? And maybe I'm looking for something more.
Yeah, and I think, Seth, you go from robo-advisor, relationship, and so forth, but what ends up usually being, that transition is either the market condition or the life events. That's, it's hey, I'm either outgrown that robo-advisor or that 800 number at, XYZ big, mutual fund powerhouse. And I really want to talk to somebody because either I'm getting married, I've just experienced a divorce, I've got a real estate sale, or, something's going on, or I am on the brink of retirement, and I need someone to solve this income problem that I've got. Those are all the booms of like why we get, injected into someone's life. Like, how can you help me?
Yeah, it's always something that, our conversations tend to start with a problem, so we're called upon to help people navigate that and kind of work their way through it. And the problem isn't necessarily bad news. It's just something has changed, whether it's the market or life circumstance. It's gotten people feeling confused, concerned, and all of a sudden aware that they need some advice. So that's why, to get back to the title of the show, the time is now, right? Everyone needs advice now. And if you don't have that proper relationship or any relationship at all, we welcome you to reach out and give us a call so we can start that conversation. And it doesn't hurt to get to know advisors like us, whether it's us or somebody else. Even if today's not the day to make that decision and get all in with somebody, start to engage the advising community, and you can take your time to find the right relationship so that you are comfortable to move forward when the event occurs. Otherwise, adding this decision on top of a major life event just makes that event that much more complicated.
Just a couple other ones out there, folks, just to make sure that you're in the loop. Have you had an employment change? Do you have elder issues? Is property ownership? Maybe you have some investment property that you're not really interested in changing out the toilets anymore in those. Those are all things that we get to sit down and have a conversation around and come together with a plan. Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about it is the time. The time is now for you to consider working with an advisor or changing up the advisor. So we were covering some of the reasons why or when people start taking a look at working with an advisor and market conditions or life events. And we want to talk a little more about why. And then we're also going to start to give you some of the the sequence of things that you need to be active around. What can you do, or even better, what not to do when choosing an advisor.
Yeah, this is a lot of people think that they build a relationship with an advisor and that's a lifelong scenario. But I've invariably found that as people make more money, have different tax concerns, different things going on, just the idea of charitable giving and how that plays into part as you make more money and how you can utilize that in taxes and be creative. And people say, well, why would charitable giving be a place? Or even leaving a legacy, like you tend to outgrow that initial advisor, and it's a story. I mean, it's part of the conversation. As Dan and I, we audit financial planners. We talk to them about bigger picture and conversation of why they're doing stuff and so forth, and we see how people kind of mature into it. But you met your buddy in college, and he becomes a financial advisor, and you start investing a little bit of money, and then you have a 401k, and you grow your assets, and then you hit retirement, and it's like, man, I've got this huge amount of wealth. Am I going to turn it over to somebody who, I know how much irresponsibility they've had in their life too. There's those conversations that exist out there, and I think it really comes down to just understanding how to take the complexity of all the different pieces together. Moving from how do I create this accumulated wealth into the premier perfect distribution conversation that's going to provide for my full retirement and all of my kids and maybe my grandkids, and how do I make sure I don't run out of money? Like, how are all of these problems and issues summed up? Well, that's where you go to a financial planner. That's where you step in with somebody who has a wealth of knowledge to be able to figure out each of those things. Meanwhile, all the complexities that come with budgeting and managing through that.
And there's no doubt that different advisors have different specialties, different philosophies, just different ways of doing things. So, yeah, it is worthwhile to take the time to find the right match, right? And why do you get engaged? That can vary a lot, but one of the things that just talked to Ben is people that come into more money, right? All of a sudden you have more than you had before, and that creates a concern for you. So that's a why moment, right? Why do you need a financial advisor? Well, because your asset picture's changed. The potential outcomes for your future have changed. Maybe you need a new voice. Maybe you need a different opinion there. But take that opportunity to get engaged with somebody and start working on what is the right plan for you.
I mean, people have inheritances almost every day. I mean, with baby boomers, there's this the largest transfer of wealth has started, and it's going to continue over the next 20 years. And a lot of people are coming into money, and they're like, I've never had this much money. I have no idea what to do, and how do I make this thing work for me? And we're at some of the lowest tax rates in history, and everyone complains about taxes, and we have more debt than we've ever known, and as a country. And how are they going to pay for that? Well, do you foreshadow a rising tax rate? Well, how do you mitigate that so that you can keep that wealth so it's just not washing away between taxes and inflation all at once?
Yeah, I mean, your 401k specialists who you've probably worked with at the start of your career, and they've given you good advice, maybe you have a great relationship, but their world is going to be almost exclusively mutual funds, right? and all of a sudden you come into wealth at a different level and you need a more advanced portfolio, they don't, and not to say that they don't for sure, but they don't necessarily have the background on those different tools.
And accumulation and distribution are totally two different types of investment strategies. And if you can avoid making it a light switch kind of event where you're moving all of your accumulation assets now to distribution assets, whatever that might be, whether you're bonds or stocks or annuities or CDs or treasuries, whatever you're looking at, they're different conversations. And if you can change it from being a light switch event into a gradual, change, a gradual shift to creating retirement in a way, it's just so much healthier and potentially a lot stronger.
So what do you ask then? You've got a ton of stuff that you've got going on in the background. So you're now meeting with some financial planner. What are the things that are important to be in the driver's seat, have confidence, and know what to be asking? One of the first things that comes up is this: are you a fiduciary?
Yeah, that's a question we hear more and more often. I think we're kind of going through my head of those kind of last 5 or 10 first-time appointments, and that question always comes up. In the 20 years I did this before, that I never heard it once, right?
I know people didn't even know what the word meant.
Right, I didn't know what it meant for a while there.
Even though you were one.
Even though I was one, yeah. It's just terminology I wouldn't have used, but it's all over the marketing world of finance these days. All of your commercials and advertisements, that gets put out there quite a bit. And what it really boils down to is whose interests come first, and in this case, is it the client, right? So that's a fair question to ask. Everybody in our business understands that, and they'll be able to answer that promptly and right away, and how they respond to that will probably give you some insight to who you're dealing with.
I'd like to add something to that, because there's people out there that say, are you a fiduciary? And, people say, yes, I'm a fee-based only planner, and that's all I do. And, that's, and as if, like, if you were anything other than that, you'd be below, that side. As we title, we're three-dimensional investors. We do, commission and fee-based and insurance, and we do all of those pieces. And what ends up happening is you can find yourself in a, fee-based only investment house, essentially, and truly be as handcuffed as if you were in commission-based only house or an insurance-only investment person. Like, you can be tied right to one type of investment strategy that may not accomplish your goals. And so many people realize, like, you can be a fiduciary, and some fiduciaries only lean on that type of investing, and they don't have relationships to do anything else, or they might not even have the licensing to do commission-based investing, where if you're going to buy Apple and you're, Apple stock and you're 30 years old, you might be something you want to hold for the next 30 years. Well, goodness gracious, you better not do that in a fee-based account, because that's going to be a very expensive relationship over the next 30 years, where if you did it in a commission-based account, it could be a very profitable relationship in comparison. And you have to understand how those things come into play. And if you're a fiduciary and you hold both of those licenses, you're still tied to do a fiduciary relationship inside of those and justify which one's best for the client.
Yeah, I mean, best interest has a lot to do with best expense, right? But it's not the whole picture. It is not the sum end of that game and that question. So, asking that question and how you get responded to is important. So you want to get that full range of explanation that Ben
you want to make you want to make sure that the person is a fiduciary, absolutely, but you want to make sure that their only motivation is not tied to fiduciary management, because you could end up paying a whole heck of a lot more and never realize it if you don't understand what their licensing strategy is.
Which actually runs immediately counter to the rule and the explanation and the definition all at once,
Exactly. It's ironic.
So basically what you're telling me, Ben, if I have one widget over here to sell and I'm a fiduciary, but I only have one widget, then everybody's going to qualify for that widget no matter what. And that is what goes against the understanding of fiduciary, because it may not be what's best for the client.
That's right.
Welcome
Make sure
to
you got more
government.
than one widget out there, folks.
Welcome to the government.
And that ties right into the next question you should ask is, ask of your advisor, how do you get paid?
Yeah.
Right, which is also a fair question. I know, I was raised in a time and a place where that was supposed to be uncomfortable. You're not supposed to ask things like that of people. But in this business and as an investor, you better, right? You really want to understand that, because that has a direct impact on your bottom line.
Yeah, that's very, very important. I think the other, as we kind of go into what to ask, and this is really, inside crises like this, like you don't want to just move because you like the person, though you have to have a really good relationship. You have to have a good rapport. And I would say that, qualifications, licensing, and experience. Our team here, our team has well over a century worth of combined experience. And that's, I think, when you start looking at the volume of people that we have to work with and the experience and the relationships and all the different types of investment work that we do, from tax incentive investing to, whether it's fee-based planning, whether you just want to get a plan or you need some insurance or whatever, whatever that story is, we have those. You need someone to do your taxes. We have someone here to do your taxes. I mean, that's the kind of all-encompassing relationship we have. But we don't all do all of this stuff. We have relationships here, people who do each of those pieces. But you have to understand the qualifications. You have to understand what licensing they have and where that experience is coming from. Because if you're speaking to somebody who has all the licensing you really want them to have, but you don't understand it necessarily, but they don't have the experience in the issues or the concerns that you're trying to solve or deal with, like, it's all for naught. And I think a lot of people, I like this guy, he seems like he knows what he's talking about, but this show is really about helping you ask more educated questions. Do you have experience in retirement income planning? Do you have experience in estate, legacy planning? Do you have experience in building charitable programs that, emphasize those types of concerns I have and inside the legacy piece? Do you have experience? Do you have somebody who can help me do wills and trusts? Yeah, we have someone on staff that can do that. You have somebody who can help me with my taxes because I'm not really sure how these correlate. Yes, we have someone. We could actually meet together in our conference room and solve your problem today and figure out what your concern is. We might not get you what answer you want, but it would be the correct answer. That's a scenario a lot of people have. But then what, and I know I'm taking the mic here, guys, but then it all comes down to investment philosophy, right? I mean, like, if you don't agree with a person and they say, hey, I really want to, buy Facebook, Meta, and put all my money there because they're going to create this 3D virtual world and, all my money is going to be worth a lot. Well, and you're saying to yourself, I'm not sure that I want to put all my faith and assets into my, Mark Zuckerberg. I think the guy's a sleazeball. You might say that your philosophies don't meet. And if that doesn't work, you need to run because it needs to be a good fit.
Yeah, there's a lot to be said about that. And every once in a while, it comes down to alignment, right? Are you aligned? Are you able to really sit there across the table, shake hands, and understand what it is that you're doing and why, and who you're doing the business with and why, right? And those things come together. When they do, it's awesome. It removes so many of the obstacles moving forward. Folks, you're listening to Money on Tap. We're going to take a quick break. We'll be right back. Thank you also for going out there and subscribing to Money on Tap in your podcast. You can reach us at 855-226-8551. We'll be right back.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the time is now for you to learn what to do when choosing an advisor. And now we are actually going to get into some playbook for you of what not to do. And one of the things that we were just spending quite a bit of time talking about is the fiduciary, how important it is to understand kind of the fullness of what that relationship is. Really understand how people are kind of selling this thing out there too. They're marketing it, right? And that's not a bad thing necessarily. It's what people want to make sure that you're aware of, but they're putting it into a way that maybe separates you from what the whole market has available for you. And because that's the only thing that they're really focused on. They're only doing managed accounts in the market. And that's what they fully believe is the end-all be-all and the solution for wealth management. Well, there's so much more out here to be aware of. Our philosophy at Brayshaw Financial Group is that you at least have access. And when those are appropriate, those are presented in a way that empowers you to make a decision. and we're clear on what the fees are, what the structure is, the reasons why not to. It's a full disclosure discussion for you. And that to us is really what we're talking about. Have a fiduciary in place for you. So don't go out and hire a non-fiduciary would be the don't.
Well, I would say that the don't that I was talking about earlier was that, don't hire a company you can't talk to the same person twice. I mean, so many people, they have an 800 number, they got to call so-and-so, and, the market drops, and they're trying to figure out, well, I liked what that guy said, and he had some recommendations. I want to talk to him again, and, well, he's not available, and, I don't have enough money to talk to, this Premier League team, and, it's just a game. And I think when you're really focusing on some of the life events, specifically retirement or estate planning, or you're kind of graduating out, or you left one job and you have a retirement plan you need to roll over, you want to be able to talk to that person and understand what the philosophy is and all these different things we talked about, because otherwise it's just a guessing game. And and not that the market has any sort of guarantees in it, obviously, but you want to make sure that how you want to invest is aligned philosophically, that you believe in those investments and that you believe that to be the right decision and you're prepared for the risk associated.
Yeah, you just want to have a relationship, right? You want to have somebody you can go to who knows your story, knows your goals, someone you've spoken to in the past, is familiar with what assets you hold, and vice versa. You know what their philosophy is. You know what their advice may well be. Or you've had conversations in the past about, okay, when this happens, we'll do X. When this happens, we'll do Y. Well, if you just call into the void of 800 whatever, that's impossible. You can't stay engaged. You may hear, well, we trade notes, we record, portions of these conversations so we can be referred back to. Well, you don't want getting advice to turn into a 3-week process either. You want to pick up that conversation where you last left it immediately, right away, so you can make real-time decisions. And
in real-time decisions, by the time you know it's an issue, by the time most of the people understood that what was happening with the banking crisis, we were watching it live stream. We were making decisions. That's not happening for the average investor, right? By the time they look at their 401k and it's dropped, they're like, oh my goodness, what happened in the market? Why is that happening? The Fed raises rates a quarter point in response for this, and the market closes, down 500 points. No one knows that's not going to happen. No one knows that happened today. They don't know how that translated in their retirement plan, because guess what? The mutual funds don't report their values to the end of the day, and you'll see it tomorrow.
Yeah. With our clients, when two things happen. When something happens in the market, we know who we need to talk to that day. Or when the phone rings, we can almost anticipate why they're calling. Right? It's because we know these people. We know the clients that we work with.
Well, a good example is I literally, a client needed some money. They were doing a trip and so forth. And I said to him, well, to get the money out and to address the tax issues you have and what's going on in your life, we should take some money from here and some money from here. And they're like, oh, that's perfect. That's exactly what I needed to know. Because we know the story behind them, Dan, as you spoke. And then finally, the last thing here is make sure you've vetted your advisor.
I was reading through our list and I was like, yes, absolutely. Vet your advisor. Don't do business with somebody that doesn't listen to you.
Thank you for joining us for Money on Tap. Today, we wanted to do a playback on what you, our radio and podcast listeners, have been queuing up this year and bring it back one more time for 2023.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today, the topic is Sizzle or Fizzle in 2023. What are the markets going to do? You know what? The glass ball is coming out today, folks. And we're going to have a little bit of, you're going to have to hold on and wait and see what it's going to be.
I think there's so much diversity in opinions of the stock market right now, and watching it rally, and the Fed's decision to raise a quarter point, and there's a lot of moving parts here. I was actually really surprised, based on a few comments made by Chairman Powell, just in the idea of the quarter point, in saying things to the effect of we still want to see 2% inflation. To see 2% inflation, you know how far below 2 we need to get to to make the average 2 over a 12-month period right now? We're talking 6 months of below 2 at least, or more.
And I couldn't believe it listening to his last press conference. They actually used the word transitory again. I was like, I thought they had stricken that from the dictionary.
I think the second you hear anybody say transitory, just say, I'm in the middle of a lie, and I just need to say it.
Yeah. Red flags there, folks. Red flags.
Transitory. Oh, my goodness gracious. I'm so tired of, I mean, they should have raised a half a point. They talked about they don't like these big, huge swings in the market. They wanted a more calm market, and yet, the market takes off the second he says a quarter point. I thought for sure that they were going to do a half a point. I felt like they were, but to be going three quarter, and then quarter point, it's like.
I mean, the market must have rallied 5% since they declared it, right?
In 30 seconds.
Yeah, it's fictional.
Yeah, it's ridiculous. So the idea of all this stuff is just, it's crazy. We've got a lot to talk about with the market for sure.
Folks, today we are talking about the market. Is it Sizzle or Fizzle in 2023?
Yeah, I mean, if we look at what January's done for us, the Dow was up 3%, the S&P up 6%, and the NASDAQ up 11%, which coming off of where we ended last year and kind of what the sentiment was in the market, it certainly got a lot of people kind of scratching their heads as to, what is driving this rally in, a time where it was supposed to be fairly bleak. But I think there's a couple things that we can look at that are really, leading indicators as to where the kind of the optimism is coming from. And that's, primarily been the Fed's latest move, right? So they've been increasing at 75 basis point increments, basically all throughout last year. And this year, for the first increase, it was only 25 basis points. And there's a couple other, indicators in the world of inflation that have people feeling like, well, maybe that time is coming to its end and we're going to return to the prior normal. But the fact of the matter is, inflation's still high relatively compared to what it's historically been at. It was still not really anywhere near where the Fed's got targeted for an inflation rate.
Listening to Powell speak, it makes me really nervous watching the market bounce. I mean, they mentioned over and over again they don't like the market having these huge swings. They want to calm down the market. They think it's unhealthy. It's not good. It's interesting that they, free trading marketplace, they want to still control. Right. I think that's an interesting perspective. And it's important for us as investors to know that there are people that are intentionally trying to manipulate the market because that's what they're doing, right? Like you can go to jail for manipulating the market, but if you're the Fed, you don't. Those are concerning factors for me because if they have a goal and they do control the money movement in this country, and the rate at which they charge for it, it becomes a very concerning issue long term. I mean, ultimately, you talked about wanting inflation to be around 2%. I mentioned this earlier in the show. The idea that how are we going to take a 6.5% inflation rate or around 6% and say bring that thing under 2% or 2% as an average over a 12-month period with all these higher months behind us? It's going to take years to get there.
And the fact of the matter is, I mean, that they did increase the rate again, and people are reacting like it was a decrease. I mean, it's just because it wasn't as painful as the prior 6 or 7 were.
Well, and this. I mean, there's a lot of people that were saying that, this really presents a sentiment that they could have rate decreases coming a lot sooner. And they're kind of like there's some health, I think, to not jacking in another 0.5% in the idea of seeing how much carries forward from the changes they've already made. Because everything they do is a rear view mirror perspective, right? They're always looking backwards. They're trying to project forward, looking backwards, and it takes time for all this stuff to trickle down. I think the trickle down is going to be a lot worse than they realize, and the outcome of this stuff is going to be a lot more difficult on the economy and people around us.
So you're saying that you feel that the trickle down effect is going to be basically not a soft landing, like they've tried to estimate through their rate increases over this last year.
Oh, I think.
Are you feeling like?
Yeah, I think there's going to be a big thud. I think there's going to be a painful thud. I mean, when you think about rates, they affect the housing market first and foremost. And I think about every tradesman out there, swinging a hammer, pulling wire, dragging pipe. I think about every one of them and the amount of halt that we're going to have in the trades and building that's going to happen because of these. And you also have to take into perspective that pretty much everyone did almost every house renovation during COVID that they ever were going to do for the most part, right? I mean, they either moved or did the reno job because they wanted better space. And now they're like, well, I have this better space, and yet I can't go move if I want to change homes because I'm going to be at, 5-6%, 30-year fix, which is 2 times what I have right now. That's a hard thing. And all of a sudden, these trades, they're going to hit a halt. And every time the Fed raises rates, and we know that they're going to raise rates again. I mean, they're not at their 2% marker. The unemployment numbers aren't there. Rates are going to be, I mean, the whole idea that the Fed's going to be cutting rates by the end of the year, with what they've said, that doesn't really match up. I know what people are saying and why they're saying it. and that's probably a lot more detail than the show needs. But I just think that to get to the markers that they're declaring, we've got a lot more rate increases to go.
And this is, in a local kind of broadcast area, I think a lot of people would probably recognize this. But, I go down to Boston pretty often, and, one of the kind of easy eyeball indicators to me is how many cranes you see up. And there's fewer and fewer and fewer every time I go.
Yeah. I remember a few years ago, you'd go down there, it'd be like, it was Crane City.
The expansion's been absolutely incredible for these last 3-4 years, but it's starting to dwindle. And it's not, there's not zero, but there's nowhere near what there once was.
And there's going to be that, kind of like that people have to fulfill their contracts, right? So that this work is going to complete, but it's the new pipelines, like the number of quotes. I'm talking to contractors and they're like, yeah, it's definitely slowing down. Like they could see it. They're seeing it and they're preparing for it.
They're actually answering their phones now.
Yeah, they're actually answering their phones. They might actually come and do the work for you now.
Wow, that's new.
So I think the idea that there's still going to be more rate increases is really what people aren't talking about. Is that the mortgage rates are going to get more and more unbearable. And I was talking to a mortgage broker the other day, a great guy. I thought, he really works for the buyer. I mean, it's really great to see that. And he's like, it's really slowing down. Like, he's an optimist. So that scares me a lot.
Well, I love the leading indicator there, Dan. Pay attention to the skyline. See how the cranes are doing, how many cranes you got up, and that's a good indication of what's going on around you and how safe the economy might be right there. But we're seeing something healthy in that tech market to be able to see those gains come back.
I think about like the NASDAQ, it was like early 2000s. It hit almost like 4,000. I don't know if it actually hit 4,000 or not. But, when you fast forward on it and you look at like, post 2008, early 09, it was at 1,700 on the NASDAQ. Now, fast forward to today, it's trading over 12,000. But it was as high as like 15, almost, was it 15 or 16? I can't remember where it actually, I think it was like high 15s and almost peaked out at 16. But, you're looking at a 12,000 on the NASDAQ. The volatility of tech is horrendous. But why so much growth in 20 years? I mean, you think about the amount of growth from post 2008 to now. That's crazy growth. Just buy the NASDAQ. I think we have a lot of competing factors. And as Seth, you make some really good points. And it's like as you're talking, I'm like going through, one competing factor after another, one decision question that everyone has. Like we have people aging out of the working force, right? We have, 40 plus million people retired. We got another 80 million that are going to retire. It's like 40% of America is going to be retired. Unemployment, it's going to be, no matter how much they raise rates, it's almost still going to be difficult to find people to work because the number of people working is naturally declining because, the number of births are again down this year. It's like there's less people being born into the Social Security system to pay Social Security. That's a whole another conversation. But we have to continue filling the jobs. So where do you replace people? Technology, right? So then you're saying to yourself, okay, well, hey, listen, we saw this drastic turn down in the mid 2000s, and but there's going to be a massive pouring into the tech space too. So you've got these competing factors, and how they're actually going to play out over time over the next 20 years is going to be an interesting story.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Hello, everyone. This is Dan Mickle on the Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Ann.
Welcome back to listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are talking about Sizzle or Fizzle in 2023. What is the prediction here in the markets? Because as of January, it has been on fire.
Yeah, I mean, we've talked a bunch in some past shows about historical trends, right? A lot of people, will look to history to try and predict the future, and that's a big part of what we do. But, we do that with the understanding that not everything, repeats itself. But if you look back through kind of the history of big drops in the market, there's a lot of material out there that would support in the following years that you have an equal or greater rebound. In fact, if you look at some of the biggest drops we've had back to 1937, 38.6%, 74, just about 30%, 2002, 23%, 2008, 38.5%. Each one of those big drops was, followed by at least a 20% return in the index. So that's a strong indicator right there that 23 will be, not only better than 22, but a significant rebound. And then we've talked a lot about the midterm election, history, which is 19 for 19, shooting 100%, where every year after midterm election, regardless of which party wins, the market's up the following year and to an average of 16%. Not every year has been that good, but that's the average. So, that's two strong indicators there.
That's 19 midterm elections. So that's, 4 years, right? Yeah. So that's, almost 80 years of history that's driving that statistic.
Yeah, that's not short term. And, in fact, the only years that we didn't get that kind of a significant rebound following, such horrific losses were in 1930 and 31, which was the Great Depression. And I think, whatever doom and gloom you potentially read about out there, nobody's pointing to that.
Yeah, I don't think there's nothing about what's going on in the market that says to me like we're off to the races. Saddle up, buy as much as you can, and go there. I just don't feel that. And if anything, I think you take your selected profits and you put some money in your pocket and you look for another opportunity to enter either in that stock again or some other asset that's been overbought.
It's something else I came across. Berkshire Hathaway, Warren Buffett, his investment company. They're sitting on $88 billion of cash right now, and that is by far and away the largest cash position they've ever had.
Yeah,
these guys like to buy. They jump into stuff, but when they do, it's not small. But they're clearly poised and waiting for something.
Yeah, there's a number of different financial institutions that I think the thing is a lot of people think that the market will be up, and I think that midterm election statement. I generally kind of agree from November 1st to November 1st, which is that statistic, right? So we're already 3 months into that scenario plus. I really do think that we probably will be up from the November 1st later. But we're already a third of the way through that,
right?
Right? But I don't think we've seen the bottom. I really don't. I think when you look at the S&P numbers, like you could buy stocks and you can manage through this, but I don't think you've seen the bottom. And there's a lot of investment people out there, a lot of companies that all they do is predictive analysis that just say, we have not seen the bottom.
There's no way of knowing which of these indicators is going to pan out. We've spoken at length in some prior shows about how there really are some competing historical facts out there that trying to project into the market is really difficult to do. And we certainly don't have that crystal ball. But we do have an approach to doing well in this market, and we do have a type of stock that we look for, and I think that's going to bode well. It's really about trying to find that quality that's out there.
Yeah, I think when I don't know about you guys, but I really feel, and I don't, some of this stuff plays into when we don't try to time the market. I think that's one of the things. We definitely take a hybrid approach that a lot of people don't take. You deal with people who we've done shows on. Active and passive investing and so forth. And, if you're not familiar with that, it's something you can definitely, listen to one of our past shows on. But, the concept of just passively sitting in the market and allowing it to do what it does, we generally agree with that. But we do have some fundamental triggers that say we need to be out. And that's bode well for us, very, very well. In times when the market, like our S&P holdings went to cash back in April, and we've played in and out of that a little bit. So we take an active and passive approach to it. So when certain things happen, we turn on the active things like, hey, listen, we believe there's an efficiency to the market. We're going to carry through. But when the market becomes inefficient, when crazy events happen and things feel like they're off the rails, there's a portion of us that just goes out. And that gives us, we want that volatility out of our portfolios. And we've done really well with that. And I don't know, based on some of the fundamental work that we do, whether we'll be in or out during these certain times. But I do think that in the S&P piece, and I have a lot of data that backs this, is that we could be really looking at, below 3,500 on the S&P. I really think we could be seeing that in a range that, might even be half of, 32 maybe. Who knows how deep it goes. But I don't think that this 4,000 range of the S&P is realistic for the whole year. But that being said, the market's moving up and down, whether we're north of the November 1st S&P of last year to November 1st this year, I do think is going to be positive. How deep this swing goes is going to be, what is to be told.
Yeah, there's a lot of different perspectives out there, really depending on what kind of an investor you are. That passive investor that Ben was talking about, where you just buy the market and you hold on and you just you let the market do whatever it's going to do, or you're active and engaging in that market. Some of the people that I have enjoyed following do have a similar perspective, where they're looking at charts and they're kind of taking a lot of the emotion out of the investing and purely looking at what does the chart tell us. And some of the things that they've been talking about is the market returning back to that 2008 level, which if you're taking a look at the NASDAQ right now at about 12,000 would bring us to, where would be right around 8,000 on the NASDAQ. And on the S&P, that would be returning back to a level of around, we were at 23 on the S&P, and right now we're at around 4,000. So, almost half. And what are they looking at? Purely, they're looking at like, where does the support in the chart happen? Where does the pullback in the support? And some of those have been big pullbacks. And in that larger picture, that going back to the S&P for the last 20 years and looking at that, that's kind of where they're coming from and saying, well, it's likely that we'll have something like this happen in the S&P or the NASDAQ or in our markets. And so that's one perspective. And how do we take a look at that?
I think that's great. I don't want to forget this, but I think that's a great point, because I think people don't think, if you say those numbers, they seem unrealistic. It's like, how could we go that far down to 2,300 on the S&P? But these things have happened over and over and over again in time, and it couldn't happen at a better time than where interest rates are now with the fixed rates. Like, Dan, you were talking a few weeks ago about a fixed annuity paying almost 5.5% over a 5-year period or something like that. I mean, what better way to park your money in cash if this craziness is going to happen and you're walking through the retirement door? Sorry to take your thunder, but I'm like, no, it's people don't think 2,300 on the S&P could happen. I don't think it's going to happen. I'm not as negative on the charts as those, and I know what you're talking about, but I do think the low 3,000s. I mean, I see 3,200 on the S&P. I mean, I'm probably going to buy in more, on the S&P holdings alone.
Yeah, I mean, it's dramatic to think that that's even possible, especially on the heels of last year, right? That's talking about another 20% cut, from where we stand today, more than that. So that's, that should be significantly concerning. But there are opportunities out there to, through various investment options, to kind of protect yourself and make sure that, at least that money that you have to have for retirement is in a position to not suffer those losses.
We're talking about Sizzle or Fizzle. In 2023, the market over the last month has been up and up big, which is a really interesting conversation to have on the tail of what looks like a bear market. Is there more bear to come? Is there more bull to come? We were just talking about charting the S&P, charting the NASDAQ. What does that even mean? What we're talking about when we take a look at charts is trying to understand different movements in the market. And if we take a look back, over the last year, we can see where the market peaked, rolled over, and then dropped. And that has happened several times in our market. One of the most significant was 2020, going back into 2008. So there's the history of what the market has done, and being able to see that helps us to kind of prepare ourselves a little bit. We're optimistic. We love to see the market go up, and we're investing to increase, to be of increase. That's what we're doing here, is multiplying money. And that's what we're called to do, frankly. So in a in the market that we're in right now, we, say, hey, this is great. We're seeing the market turn around. Now we're going to go ahead and pull all of our money and put it back into the market, or put it back into the NASDAQ, both of which are the market. Or do we take a look at this and say, okay, are there other opportunities for us to really protect our clients from the possibility or the high likelihood that the market has more losses in the future before it has the returns. And, in this next market, this market ahead of us, I think what we're seeing right now is a lot of the buying action, a lot of the optimism, a lot of the mean reversion off of the recent pullback. And how long does that last? Frankly, we could see the market go up over the next year and have that 20% return over this next year. But does it beat the previous highs of 4,500? I don't think so. I think what we see is we have a new ceiling there, and it's going to have to be some really positive influence in our economy for a while in order to see us break through that ceiling. And what the markets will typically do is they'll touch that ceiling and then they'll pull back. And I think we're going to see a lot more of that, bumping up against that ceiling, pulling back, new lower lows. What that news is going to be, we don't really have. That's the part that we don't know. But there's things out there that are out of our control, out of our understanding, that will affect the market. Right now, it doesn't look like the Fed increasing rates is going to be the trigger for the market. It doesn't look like the unemployment rate is going to be the trigger for the market. So in the meantime, how do we be successful through a market that just isn't telling us go, go, go?
I think there's two things, well, at least two, but two that come to mind for me. And it kind of really depends on where you're at in life and which asset we're talking about. If we're talking about those retirement dollars that you just need to plan around and have to have, and you're nearing that point in your life and you've experienced this loss that we just went through, there is some good product out there that, would allow you to participate in the market upside if and when it occurs, but also put a safety net under the value that you have today and guarantee you no loss going forward based upon negative market performance. And if it's money that you intend to take out as an income stream at some point down the road, we can actually guarantee some growth between here and there. So that structure of contract exists, and that's something that we advocate for in the right opportunities. But if you're more of a long-term investor and you want to stay fully in the market, or you have just a particular asset in mind that you want to keep in the market, this is the time to be, I think, really selective. And you got to be looking for stocks out there that have, a track record of success, a track record in particular. This is one indicator of paying a dividend and increasing that dividend over time, through different market cycles. Because I think that's where, regardless of how the stock price fluctuates on a day-by-day basis, you can get some predictable income off of it. And with the recognition that, you're invested in a company that's got a track record of success and actually knows how to make money in every different kind of environment.
I'm constantly running filters. I'm always looking for things and spikes and changes. And, a lot of the things, there's so much predictability to fundamentals. I think that's what we all go through this. And I love how we get together as a group and, we debate through these stocks because there's 1,000 different places, 10,000 different places to put money for our clients. And I think, when we narrowing it down to 2 or 3 or 4 places that we want to put money, it's hard, right? I walk away from some of the meetings disappointed, I really wanted, I thought that was, and we trust each other. We work through this stuff but we're talking about degrees of, finesse, right? I think that's really where it comes to. You're looking at PE, you're looking at beta, you're looking at potential alpha, you're going through these, relative strength issues, and you're looking at all these different fundamentals of, all the stuff that's moving and around. And then you look at the overall market and you're saying to yourself, okay, well, how will this stock or this, general, genre of investments actually perform in a market that's, moving like this? Are you going to buy, a blue chip value stock when everyone's going tech? It's but the thing is you got to really figure out where you want your money. And I always like to put my money in a company that has real profit. And make sure that there's just an actual profit margin to it. I think if you go into a company, irrelevant of how good of an investor you are, and you find somebody who has a solid profit and the company name, it's there's a lot of reassurance to that. Even if the stock goes up and down, they're making money.
You have been listening to Money on Tap. You can reach us at 855-226-8551. We've been talking about Sizzle or Fizzle in 2023. Hopefully, you are a successful investor or becoming a successful investor. And that's what we're here for, is to help you take that next step. Thanks so much for joining us this week. We can't wait to talk to you next week. Take care.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.